I'm Howie Lim. This is Money Hacks by the Business Times.
Are you willing to surround yourself with very diverse perspectives? And are you willing to hear what you don't want to hear? You have to make the decision based on the information you have and what makes you feel good about that decision.
One question I always ask is, what do you expect the market to do when it reaches a peak? Most people say, oh, it's a peak, so it will go down. But no, it goes on to make another peak.
Each individual financial situation is different. Given the potential heightened volatility that may be expected in 2025 due to the given macro events, it's prudent for individuals to actually undertake proper portfolio diversification.
Has to be done, trying to figure out where to put our money in 2025, especially since many are saying the stock market will rise in 2025, just nowhere near as much as 2023 or 24. Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim, and if you have feedback or an idea for a podcast episode, do get in touch, btpodcasts@sph.com.sg. Joining us today, Samuel Rhee, Chief Investment Officer of Endowus, Kelvin Wong, Senior Market Analyst at Oanda and Rohith Murthy, CEO of the MoneyHero Group.
I think it's been a very interesting 2024 for a variety of reasons. Obviously, the geopolitical landscape is also changing as we speak. Going into 2025, there are probably two things. One is to pay attention on what are really the macro trends. People obviously talk about AI, they talk about clean energy, all of these things get talked about. But there are lots of information and data and signals. If there are companies investing heavily in a certain industry or sector, they talk about it, they report it. There might be a lot of infrastructure plays that's happening. So I would pay attention to those. Who are the big companies? Who are the big markets investing in what? And I think that's an important trend because we are going through a very interesting transformation when it comes to AI and it comes to technology in itself. So one is pay attention to the macro trends. Don't just go for the hype. The second thing is downside risk. I would go into 2025 and really pay attention to making sure I minimize the downside risk as much as possible. So rather than just focusing on having a great year, if there was a bad year, let's make sure, it's not a really bad year. So personally for me, those are the two, I would say, counter things. One is this great macro trend happening. And what does that mean to me, to my job, to how I think about my investments? And then going into 25, what could be the worst case scenarios and how do I minimize my downside risk?
Makes sense. Is there a need to see where we came from, i.e. 2024, in order to know where we're going? Here's Samuel Rhee from Endowus.
Yeah, this year turned out to be a great year for investors. I just wrote a piece on Business Times. It was about FOMO because we're in that stage where equity markets and just generally a lot of risky assets have done tremendously well. Bitcoin's just hit 100,000. Equity markets globally has done well, US especially well. And so you're looking at 2 years consecutively of double-digit returns, which is not unusual, but a great outcome for most investors. The problem is, though, when I talk to investors, very few have been fully invested in the markets throughout the year. Most people are underinvested. People have too much cash because interest rates have been high. So fixed deposits have been attractive, it seems like. But, as a result of that, people haven't been really invested in equity markets to the amount that they should have actually invested, especially in a great outcome year like this year.
2024 has been a banner year for the US stock market as the major US stock indices continue to outperform against the rest of the world, especially the high-flying mega-cap-centric technology-heavy Nasdaq 100, and also being the top performer as of 9th of December among the four major US stock indices. The Nasdaq 100 is up by 27% year-to-date. On top of that, despite the Fed has kickstarted its interest rate cut cycle in September this year, the US dollar didn't decline, but it actually rallied further. So one of the primary reasons for this recent strength in the US dollar is related to the upcoming new administration, which Trump has re-elected as president. And based on his campaign trail, he actually voted to engage with higher trade tariffs against US major trading partners, and as coupled with steep or generous corporate tax cuts. So these two key flagship policy maneuvers is likely inflationary in nature, at least from a medium-term perspective. So potentially next year, there could be some signs of deflationary trend in the US to stabilize. And in fact, inflation may see an uptick in the later part of next year, and that actually support a less dovish Fed in 2025. And also on top of that, despite we see movement in the US dollar index strengthening since Q4, gold managed to survive this onslaught of dollar strength, but instead rallied together with the US dollar as well. So year-to-date performance as of 9th of December, we managed to notch out a stellar gain of 28%. Number one, the incoming Trump administration, America First cornerstone flagship policy may start to see tit-for-tat measures, especially on the trade tariff side of the story, and higher budget deficit that might get widened further in the years to come due to Trump's generous corporate tax cuts, see a higher risk of diversification away from US Treasury, potentially against the US major trading partners that Trump wanted to impose higher trade tariffs. And also with this risk of widening of the government US budget deficits, that could actually see higher chances of government shutdown. So that support gold demand due to its safe haven appeal.
That's Kelvin Wong from Oanda, and they all caution against putting too much weight into one-year targets. It's extremely difficult to predict short-term moves in the market with any accuracy.
The mega cap, yes, the first half of the year, we may see a further melt up due to market favoriting optimism side of this steep corporate tax cuts coming up from Trump's administration, American First policy. But we may now start to see a bit slowdown in the mega cap earlier outperformance in the second half of the year. Why? Because market will now start to look at the negative impact of trade tariffs that could have on the revenue stream of this mega cap technology sector or stocks.
With so many analysts saying 2025 won't be as lucrative as the last 2 years, where should we put our money and how can we manage the risks going forward? More with Samuel Rhee from Endowus, Kelvin Wong from Oanda, and Rohith Murthy from MoneyHero Group.
BT Correspondence welcomes Transport BT, the newest member in the channel's lineup, providing in-depth commentary and a 360 view on all things transport. Join correspondent Darren Wong as he explores the business of the sector and the policies that govern it. Hear from the industry leaders who will join him to provide context and insight. BT Correspondence, a new episode every Tuesday, wherever you listen to podcasts. Subscribe and listen today to BT Correspondence.
And now, back to Money Hacks from the Business Times.
We're hearing that the stock market could rise as much as 16% from current levels in the first half of 2025. But much of those gains will likely evaporate in the second half before a year-end recovery takes hold. What does that mean for portfolio rejigging? And what about market volatility, which seems as constant as death and taxes? Here's Rohith Murthy from the MoneyHero Group.
I think the herd mentality, especially in today's day and era where information flows so quickly and you have Twitter and you have social media, it's a very easy trap to fall into. I generally make an effort. I have confirmation bias about things. So that's a bias I know I have. And I'm passionate about finance and technology, for example. And I will try and find all data and evidence that is convincing me I should do something. But then I have to get out of my comfort zone and I will speak to someone who will completely think otherwise. I have to listen to their perspective without, getting disappointed or without getting in any way emotional about it. That requires some effort. So I think the herd mentality trap will always be there. But it's a question of, are you willing to surround yourself with very diverse perspectives? And are you willing to hear what you don't want to hear? You have to make the decision based on the information you have and what makes you feel good about that decision.
So the first thing I would say is that if you look at the history of especially the US market and global markets as a result of that, whoever has been in the presidency doesn't really affect the outcome of markets. It's driven more by fundamentals of the economy and companies and how they execute. So Trump coming in and of itself, I don't think changes the narrative that equities should remain a core allocation over the long period of time. If you remain in the market, then it should generate a long-term average return of anything between 8 to 12%. And as a result, whoever is president, equity markets have always gone up, right? Short term, the economy goes into recession or there's a shock like COVID, market falls, but then it recovers and continues to go higher. So it doesn't matter whether it's Trump or Kamala Harris or anybody else, the market will continue to do what it's going to do. But what is unusual this time is that Trump has come out with some very, very drastic and noisy policies regarding a very strong US-focused, US-first, US exceptionalism, whatever you want to call it, this very heavy focus on the US. And he's going to use many tools like tariffs and other things, pressure, to put the toll on other countries so that the US will benefit. So as a result, what is happening is that the US exceptionalism, that's the phrase that's being used these days to say that, hey, US is doing fine, the economy is doing better than everybody else, the stock market is doing much better than everybody else, the dollar is stronger than anybody else. And so the US exceptionalism is likely to continue during this Trump administration because it's so focused on that aspect of it.
And according to economists, the global economy is projected to remain resilient despite significant challenges. Here's Kelvin Wong from Oanda.
In terms of sectors performance, we know that the US stock market is being divided according to sector. With this less dovish Fed and higher US Treasury yield going forward, that could lead to a further bear steepening of the US Treasury yield curve. That means, i.e., the 10-year US Treasury yield rising at a faster pace comparatively against the shorter tenure like the 2-year Treasury yield, as the Fed may be on hold for next year or the entire year of 2025. So that could see an outperformance of the banking sector or the financial sector in the US, where banks' net interest income continues to actually improve, provided that the US is able to maintain its Goldilocks scenario. On the other hand, we now start to see very, very weak growth in Eurozone, as well as Trump administration American first policy that centered on trade tariffs against major trading partners. That could also see boomerang impact negatively on the Eurozone and especially on China. So that being said, we may start to see a bit of policy panic in Eurozone and China. Potentially central banks in China has already kickstarted their much more expansionary monetary policy, and that could follow suit by ECB as well. With that in mind, a higher liquidity coming from these two major developed economies, Eurozone and China, that could actually spur up cheaper money being flowed worldwide, and that could increase capex expansion by corporation. We may start to see an increase in fixed asset investment. That means there will be a higher need for infrastructure spending. So that could benefit the materials and industrial sector.
And it's important to look at yourself and be honest with yourself, because some people think, oh, I'm okay with risk, but when you lose money, they panic and sell at the worst time. So be honest with yourself and then develop a financial plan with very precise, crystallized goals about why you're investing and what you're investing for, and only take the appropriate risk that you need to take. So don't take unnecessary risk. I don't need Bitcoin to secure my retirement. You know, if you personalize it and develop a plan, and then the most important thing, control your emotions so you don't chase the markets because of greed or sell at the bottom because of fear or be driven by FOMO, fear of missing out like these days, and you stick to your plan and focus on what's right for you. The most important thing, because last year at the end of 2024, if we had stuck to that advice, people would have done wonderfully well. The problem is that most people don't stick to that advice and veer away from that advice. And that's why I think it's important to continue to remind people that there is a right way to invest.
And we're set. Keep calm and stay invested. Same advice as last year. Next time, it's Money Hacks' 200th episode. And in that special edition, we go to video with 3 generations of money issues and tips as well, of course. Do join us for the XYZs of money. 3 generations share hang-ups and hacks. Oh, how rude. Thank you to Samuel Rhee from Endowus, Kelvin Wong from Oanda, and Rohith Murthy from MoneyHero Group for sharing insights in this episode. And don't forget to send us an email if you have feedback or an episode idea. btpodcasts@sph.com.sg. I'm Howie Lim, and this has been Money Hacks from the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.